Should I buy Zenith Bank public offer or not? This is the question I have been receiving in my DM, even in the last 24 hours. And people send me questions via email, via WhatsApp, if Zenith Bank is a buy. So I know you might have watched my video on Fidelity or Access. And if this is the first time you are watching my video or coming to my channel, kindly hit the subscription button or turn on notification bell because I share practical insights and ideas on how to make money in the Nigerian stock markets. Although at some point I will be talking about the US market very soon. Now, if you missed that video on Fidelity and Access, kindly go to the description section of this video, click the link and watch my detailed analysis on how I analyze banking stocks. I don't listen to hearsay. I don't listen to people telling me, oh, they lost money. I take my time to do my due diligence and I know the numbers to punch to know whether the bank is good or not. And I'm going to do the same thing right here. So if you are wondering, or maybe you're thinking of topping up your existing Zenith Bank stock, or maybe you don't know whether it's a buy or not, or maybe you have doubts because you feel you lost money and all that. So this video will help you answer this question and you will gain a lot of knowledge and new insights on how to analyze banking stocks and generally investing. So first thing, let's look at disclaimer. The ideas shared in this video are based on my personal research and risk profile. Kindly do your due diligence before you invest in this company's stock. And also, please note that the stock market comes with a lot of risk due to uncertainties. And whatever recommendation I share, whatever stock I mention, please vet my recommendation based on your risk profile. It's very important. So let's get started. Now, when you want to invest in a stock, it's important you know your investment objective. This is one of the mistakes people make. When you don't know your investment objective, it's like you embarking on a journey without a destination. And what exactly do you expect? Anything, because you can't even tell whether you have arrived or you are close to your destination because you don't know where you're going to and what is now the essence of the journey. So when you buy a stock without an objective, you buy a stock without a known objective in mind, then it means you are gambling. And you know what happens in gambling? When you gamble, it's either you are lucky or not. But when you apply a detailed strategy, what happens? You win. So winning and gambling are not the same. So when you are investing in a bank stock or whatever market you want to go into, first define your objective. Are you investing for income or are you investing for growth? So rather than asking me whether Zenith Bank public offer is good or not, I should be asking you that question. Are you buying Zenith Bank for regular annual cash flow or one-time profit via capital appreciation? So for anybody asking me whether Zenith Bank is good or not, I don't respond to them immediately and say, oh, Zenith Bank is not good. Oh, we lost money during. No, don't do that. Anybody that responds to you like that, just know that the person is not the right uh, advisor to reach out to. When you ask a professional whether a stock is good or not, the next best response you should be expecting is whether you are buying it for income or growth. So I will be asking you this question in response to your question. Are you buying Zenny Bank for regular annual cash flow or one-time profits? Because when you buy for regular cash flow, then you are an income investor. When you buy for one-time profits, meaning that you're thinking of buying Zenith Bank public offer, meaning that in the next 6 to 12 months, you will sell back for profit, maybe at a higher price. That means you're a growth investor. These two people are not the same. So you can't be given the same answer to different people. So first thing is define your investment objective. If you think you want to buy Zenith Bank to profit from capital appreciation, then you are a growth investor. The type of analysis to carry out, the type of things to watch out for is different from someone else that is investing for Zenith Bank for income. Even though both are investing in the same bank, in the same asset, their objective is different, and what are different, and their approach and analysis should also be different. So I will attempt to answer questions on both ends, whether you're investing for growth or you're investing for income. And for me, I'll tell you the one that I think is the best. So let's continue. Now, what is income investing? In income investing, you don't buy an asset to sell tomorrow. You take long-term ownership of the assets for regular income. So the income could be weekly, monthly, or annual. So when you say I am investing for income, it means that you're not looking to hold that asset for a short term. You're buying that asset for long term so that you can earn. The intention, the idea is to earn regular cash flow. Look at the example I shared here just to explain it better. If you buy a house today and your intention is to rent it out for regular income via rent, that is income investing. So if you own a share in a business and your intention is to collect dividend, that is income investing. So there are people who call income investors. So you need to know where you fall. So if this is your intention on Zenith Bank stock, then it means your approach to Zenith Bank should be different from the other person who is looking to buy for capital appreciation. So let me share some of the income investor that we've had in Nigeria and how people mistake income investor for Ponzi. And I'm going to share two scenarios, especially one that has played out recently and one that has been playing out for a long time. So let's look at this ownership versus Ponzi. When you take ownership of shares in the business, your plan is to own the part of the business, own a part of the business, and earn your regular cash flow. That's income investing. Now, for people that are embarking on Ponzi, so they think that when they buy a share, then overnight, in 2, 3 days or 2, 3 months, it automatically double. Then they sell back. Do you understand? So look at this screenshot I just showed right now. Jimovia's stake in Zenith Bank inches near 100 billion. This was March 2022. I'm sure it would have surpassed that from then till now. Now, Jimovia is not investing in Zenith Bank to sell back tomorrow. He's not investing in Zenith Bank with the mindset that Zenith Bank stock will double in the next 3 months, even though it happens. But his intention basically is to take long-term ownership. And that is what his mentality has always been right from day one. Now, by taking long-term ownership, what happened? He's expecting regular cash flow. And that is a typical example of an income investor. If you look at Otodola, he buys shares in First Bank. He bought a share in First Bank in June 2024. Now, and his stake has increased to 11.63. Now, he's not buying shares in First Bank to resell tomorrow or next week or next month or next year. He's looking to take ownership of First Bank. So that means he's an income investor. So I'm sharing examples of income investors so that your approach to buying shares will change. So you don't look at share as one quick risk, get rich quick scheme, forgetting that share and business are the same. When you buy share in a business, you are a part owner of that business. Now let's look at another one again. Tonelumelu to increase stake in UBA as bank seek capital. This is also another income investor. He is not buying shares in UBA to sell tomorrow. He has been a long-term investor. So his own my idea basically is I want to buy more shares so that I can earn more dividends. Take ownership. The point is he's taking ownership. So if your intention is to buy Zenith Bank, my question is, are you looking to take ownership of Zenith Bank or a part of Zenith Bank, or are you looking to buy Zenith Bank to resell later on? That's growth investing, which we will talk about. Now, look at the next one again. Otodela overtakes Otudeco. So you will see the big men in the market dragging for own, like fighting for ownership. This is the kind of news I want to see. This is kind of news I try to learn from. So Otola overtakes Otudeco in First Bank, buys fresh 797.7.9 million stake. Now, so you could see this when they buy these shares, what is their intention? Ownership. Ownership. So when you buy shares in any bank, or when your intention is to buy shares, do you think ownership? Now, I'm not saying growth is not good. Growth is okay. Growth is fine. You can buy shares, but there are banks that are good for growth, and there are banks that are good for income investing. So let me share something. before we then continue. Now, this is another case of ownership versus Ponzi. Now, I'm not attacking him as a pastor. No, I'm probably going to correct something that wasn't nice. How I lost 200 million to bank shares, Ashmolo. When I read that, and I had to go back to the news. I think I read it on Punch. Yes, this is it here, where he talked about losing over 200 million and all that. But here's the point. Now, the reason I'm showing you this is because of this word, Ponzi, ownership versus Ponzi mentality. Ownership versus Ponzi mentality. Let's go back here. Now, before you invest in a bank stock or in any stock, you are expected to do your due diligence. You are expected to carry out detailed research yourself, understand the pros and cons, understand the type of share you're buying, understand the ability of that company to survive. Because one thing about share is share price fluctuates. Whatever that has happened in the Nigerian stock market is not peculiar to the Nigerian stock market. It also happens both in US market, in Europe market, in European market, in Japan, China, Hong Kong index, Germany, everywhere. That's global meltdown. So we should not be attributing that to Nigeria. And I don't know why people are still living in that era right now. But here's the point that I want to make clear to you to differentiate ownership and Ponzi. Now, I just have to skip the first part. Shimono recounted a particular challenging experience from 2005 to 2006, when he borrowed 60 million from Sterling's Bank to buy shares in Kai Bank. This is a Ponzi mentality. You don't borrow to buy shares. You don't borrow to invest in something you cannot control. That's a Ponzi mentality. So, in looking at this line, my first question is, what was his mentality when he approached Sterling's Bank for that loan? His mentality was, I want to collect this 60 million from Sterling's Bank so that I can put it in Sky Bank, thinking that Sky Bank shares will double or go up by 300%, 200%, so that I can sell back to refund the money and pay the interest. That's the Ponzi mentality. This is one area. This is one of the reasons a lot of people lost money. This is one of the reasons a lot of people lost money in Nigerian markets. Why? Because of Ponzi mentality. You don't borrow to buy shares. That's the rule. People have approached me multiple times. Oh, I have this particular money that is sitting in my account, and I might have a need for it in the next 3 months or 6 months. What shares can I buy? My first question is, what is that money? Was it a borrowed fund? Oh, yes, I borrowed the money. No. Second, oh, the money is meant for house rent, which will be due next 3 months. I don't want to deny it. No. Oh, the money is no. This is how you invest. You don't earn salary to invest. No. You earn salary or you earn an income to save. It is when you have built your savings that you take part of your savings to invest. So you invest part of your savings. You don't invest part of your salary. Why? Because when you invest part of your savings, by the time you have a need for cash, where do you run to? You run to your savings while your investment is still running. So by having savings account or a stable portfolio of savings account, you allow your investment to grow and to mature. But if you don't have a savings and all your money is investment, what happens when there's need for cash? You run to your investment and sell it immaturely. Now, by the time you cut your loss, you assume that this investment is not for me. So that's one area people do not like. Now, he said something again. I will mention bank because it's not a lie. I bought 36 million from First Bank at 12 naira and it fell to 6 naira. I bought 36 million from First Bank and it fell to 6 naira. I can categorically tell you how this 36 million would have been worth more than 100 million. I can tell you categorically because the same First Bank he mentioned from that 2005, 2006, First Bank shares today is 22 naira. First Bank shares today is 22 naira. Let me show you something on my. So trading shares is all about due diligence. The question is, did you carry out your due diligence very well before you invested? This is First Bank stock. right here. This is First Bank stock. Now, what's the price of First Bank today? Can you see 22 naira? But then I'm not interested in the price yet. Now, if I go back to this particular line, if you had bought 36 million unit of First Bank at 12 naira, right? Even if the price of First Bank dropped to 6 naira and is still at that level, did you know that by reinvesting your dividend, what this 6 million would have returned if you had been reinvesting your dividend every year from that 2005 to 2006 today, it would have been worth more than 100 million naira. Yes. How much did First Bank pay out as dividend this year? Let me see if I can find that data. First Bank dividends 2023. Let's see if we can find that data out. Now, First Bank dividend, look at it here. Dividend per share of First Bank. Now, in 2024, 1 naira, no, 0.40 kobo. Yes, let's look at this one here. 0.4, 0.5. This was 2023. So averagely, let's say Zenith Bank, First Bank paid 50 kobo out. So by the time you multiply 50 kobo by 36 million, so 36 million, 1, 2, 3, 1, 2, 3 times 0.5, that's almost 18 million naira. 18 million naira. Now, if you have reinvested, now it may not be up to 18 million naira, it could be another 5 million, 6 million. Imagine you reinvesting 5 to 6 million back, like he's buying back First Bank shares every year. As dividend is coming, he's buying back. As dividend is coming, he's buying back. It's what these men have been doing that many of us don't know. When Jimovia Tola collects dividend, they buy back. When Elumelu collects dividend, he buys back. In short, he said something that he's going to reinvest all his dividends back into rights issue in UBA. So the question is, does he understand this kind of investing insights? And not just coming up to say, I bought shares. Because you lost money in shares does not mean the Nigerian stock market is bad. There are companies that have actually gone under in the US market. Enron, WorldCom, because of manipulations. And this stop the market from thriving? No. So first thing is look at your own personal risk profile. Now, there were issues with Skybank. The Skybank issues were clear. Skybank had been carrying negative retained earnings for a long time. So for anybody that is investing in Skybank, the problem was clear. Due diligence. People do not carry out due diligence. Now, it doesn't mean that companies don't manipulate financials, banks don't fail, companies don't fail, but it still does not negate the fact that the stock market is still good. If you have spread this 60M across different portfolio, they cannot go down at once if you carry out your due diligence. In short, number one thing is, why would you have to borrow? Because by borrowing from a bank to invest in shares, you already add a pressure. So that pressure will not even allow your investment to grow. When you even go to borrow from a bank, the question is, you are not supposed to pay back that loan from the same shares, because in shares, you allow your investment to grow. So I have a lot to talk about this that I just think it's going to be distracting for me. But then let's continue. So the question now is, what is the difference between him and this man? Well, that's the question. What's different between him? What exactly does this man know? What exactly does Jimovia knows? What exactly does Otedola know? What exactly does Ilumelu know? What exactly does Otudeko know? Exactly do they know that he doesn't know about shares? So he should not come on board and be telling people that bank shares is not good, because the same people that are responding to him and are agreeing what he said, are the same people that are still at the same level. Now, he was talking about real estate being better than shares. I don't even want to go to that extent, because when you look at the two, I don't think any smart investor at this age should be asking whether real estate is better than stock or stock is better than real estate, when both of them should be treated as siblings. Real estate can give you money to invest in stock. You can own properties, collect rental income, and put that rental income in stock if you know what you're doing and make more money from it. The stock market can also give you money to buy properties in real estate if you know what you're doing. Look at a stock like Oando. Look at what Oando has done from 9 naira to almost 60 naira. let's look at the Wando stock from 9 naira, 10 naira. Look at it here, from almost 9 naira right here. I remember I've had multiple webinars with my community members on the one. I remember how I was so emphatic on this price region here, and I told them to mop up Wando. In short, I told them, please hold your Wando going forward. Now, this particular level, key level, had been tested multiple times right here, and you can see right here, right here. So this 9 naira, 10 naira was not a coincidence. It's been acting as key level as far back as 2012. Now look at what happened from 10 naira to reach almost 16 naira. Imagine what this would have meant for someone that bought 1 million units, which is 9 or 10 M. It's almost 60 M by doing your due diligence in the market. So if you buy into stock, don't expect all your portfolio to hit at once. But what you should be most interested in is to be able to generate more win than loss. Even private equity investors. Some will say, I don't like shares, but I like to invest in business. What's the difference between shares and business? What's the difference? There's no difference. So let's continue. Let me not distract us from the thought. I had to chip in this part to differentiate between ownership and Ponzi. There is a way people act in the market. I know they are taking ownership of shares. There is a way people act. I know they are actually playing the Ponzi scheme. Some of them might not even be aware of it, but that is the truth. So let me continue. Let's look at the growth investing. We've talked about income investing. You buy a share to take ownership, long-term ownership. You don't have any intention to sell. But in growth investing, you buy an asset to resell at a higher price in the future. So you are not interested in the cash flow that is coming in. Your idea is to buy today and they're hoping that in the next 3, 4, 5, 6, 7 months, depending on when you tend to sell, the price of that asset would have increased. So if the price asset increase, an income investor will say, no, that's not why I bought the asset. I bought the asset because of the regular cash flow that is coming in. It's either rent or dividend. Now, in growth investing, you buy an asset to resell at a higher price in the future. It could be short or long-term ownership, depending on when the price reaches a satisfactory level. So you could take long-term ownership of that asset too in growth investing, but your essence is your ultimate reason is to sell at a higher price, dispose of the asset itself. You're not interested in dividend. So you have carried out your analysis and you feel that, oh, this share can go from 36 naira to 50 naira, 60 naira. So then you are buying today. So if you say, I want to buy Zenith Bank for growth investing, it means that you are expecting Zenith Bank share to appreciate from 36 naira to 37, 38, 39, 40, maybe to touch a price of 60, for instance. And then you sell back once it's 60. Do you understand? So you can see that even though you are buying the same share that an income investor had bought, your objectives are different. Now, even if any bank touches 60, an income investor will say, no, I'm not selling because that's not why I bought it. As long as any bank is paying me my dividend, I am okay. So even if any bank price crashes from 35 naira down to 20, a growth investor will say, no, I am not selling. As long as any bank is paying dividend, I am okay. That's the market volatility. But an income investor, sorry, a growth investor will say, no, I am not interested in that. If I see any sign that this bank is going to crash, I will quickly sell. Like here, look at the chart of Zenith Bank. Zenith Bank has gone through multiple waves, so just in line with the market, wave up, wave down, wave up, wave down, wave up, wave down, wave up. So a growth investor will say, I want to buy Zenith Bank, hoping that once the price rises, I will sell back. Now, when I notice a sign that it's going to dip, I'll quickly sell off or offload my portfolio, cut my loss. Now, that is what a growth investor thinks. So at this point, the question a growth investor should be asking is any bank stock going to increase? Is there any tendency that any bank stock will rise in the future? If the answer is yes, then you can because you can enter. Zenith Bank had touched the previous high of 46 naira. Right now, the market price is sitting around 38.25. So growth investor is asking whether the price will rise higher. These are the things you should be watching out for. Now, for an income investor is not interested, even if any bank stock is crashing, what he's interested is not price. He's interested in ability of Zenith Bank to continue to pay dividend. In short, every growth investor should welcome market dip like this. You know why? When price dips, it gives you ample opportunity to buy more shares. Look at the times Zenith Bank dropped to as low as 12 naira. Imagine that you have bought Zenith Bank right here you should be sitting at minimum of 40% return at current dividend right now. It's exactly what this means. So understand your objective in the market. Don't pay attention to ideas that are meant for, so as an investor, income investor, do not pay attention to ideas that are meant for growth investing. As a growth investor, don't pay attention to ideas that are meant for income investing. Know what works for you. That's why I'm taking my time to share my insight and feedback on this. Now, let's look at an example of growth investing. You buy a house, you bought a house today and resell it in 5 years. Now, remember, income investing did not buy the house to resell. He bought the house for rent. So it is that rent that makes it an income investing. But a growth investor will say, I am buying the house today to resell in 5 years. That means I'm interested in appreciation. Oh, you bought the house for 10M today, and in 5 years, the house is now worth 30M. Now, even though you have been collecting rent, that is not the objective. The objective is to sell back at 30 or 40M and then leave the market. The same thing also applies in stock market. You invest in shares and sell in 6 to 12 months. Why? Because the price has rallied. So that's growth investing. So if you're interested in Zenith Bank stock, the question is, are you investing for growth or investing for dividend? So I hope this video is enlightening and is opening your eyes now to understand why you should know your objective. You should know your risk profile before you enter the market. So don't just jump on random analysis or go to random videos and be saying, oh, this person says any bank is not good, this person says any bank is good, and then you are confused. But when you know your objective, you can easily tell the advice that aligns with your objective or not. That's why I'm taking my time to break this down. So if you want to buy any bank stock, or if you have bought before and you don't have a reason, now is the time to ask yourself, did I buy any bank for growth or did I buy any bank for dividend? But like I said, at the end of this video, you will know what is best for you. You will know whether any bank is good for growth or whether any bank is good for dividend. So let's move on. Now, which is better? Now, growth investing and income investing are both okay. So people are even hybrid investors. They have an account for growth investing, they have an account for income investing. Now, which is better? This depends on your risk profile and the assets you're buying. So I will not tell you growth investing is better. I will not tell you income investing is better. A lot of people have made money from income investing. I know people have made money from income investing. I also know people that have made money from growth investing. So both are okay. Now, whatever you choose now depends on your risk profile. Your risk profile evaluates your ability to take risk. And I also think it's tied to your age range. No, so when you are thinking of growth, you need to know the risk that comes with it. When you buy for growth, price fluctuates. Price can go up, can come down, can go up, can come down, can go up, can come down. So what you need to know is to be able to tell at what period do you think price will go up so that you can buy low and sell high. But if you don't do your due diligence and you buy at the top of the market and price crashes, you'll be discouraged. And then you will think the stock market is not good. Why? Because you didn't carry out your due diligence. So when you're buying for growth, you need to be able to tell when price is about to go up. That way, you can buy low and sell high. But when you buy for income, you don't need, that is the least thing you should be worried about. You can buy at any time. You can buy. So the question is whether you're buying for growth or investing. Now, the asset is also important because by virtue of past performance, you can easily tell whether it's good for growth or not. So it is not about your risk profile too. The asset again, there are stocks that are good for investing. There are stocks that are good for trading, which is growth, and there are stocks that are good for both. So when you want to buy a stock, you need to know whether the stock is good for investing or is good for growth. Now, when you say you're buying a stock for growth, it means you're looking for capital appreciation. Now, some stocks may not really give you impressive return via capital appreciation, maybe by virtue of the industry that they are. But you know what? They are stable. They have been known to always pay cash dividend year on year. In short, they are what we call dividend aristocrats in the market. That means when you look at the dividend history, these guys have been consistent. They have not just been consistent, they've been growing dividend payout. And by leveraging on that, you can make more money in the market. So these are the things you need to look at. So the question is any bank good for investing or for growth? Now, there are times any bank will be best for growth. Growth is, oh, assuming you've bought right here, and then, but then There are times Zenith Bank stock will come down. You can see here, you can see here. But irrespective of whether Zenith Bank is going up or not, or coming down, Zenith Bank has been paying dividend consistently. Zenith Bank has been paying dividend consistently. They've not failed. So whenever you see a share price go down, always ask yourself, is there a problem? No. Even the period where Zenith Bank stock had retraced down, like we see here, we see here, this would have been a perfect opportunity to buy as an income investor. Because during this period where Zenith Bank was pulling back, nothing happened. If you walk past any bank or any branch of Zenith Bank, people are still trading, people are still transacting. I mean, people are still doing business, people are still using their mobile app, people are still opening an account. So it tells you how stable the bank is. So I think Zenith Bank is one that is good for income investing, but sometimes it could be good for growth because price appreciate. But don't expect massive return via capital appreciation. But you know, the income can help you to multiply. So here I want to take my time now to show you the next slide. Let's now look at Zenith Bank financials. You know, I like to work with data. I like to look at the numbers because the numbers says a lot. When you work with data, it removes every level of assumptions in the markets. Like your level of assumption will reduce because you're seeing the data and data don't lie. Data tells you what it is, what is actually happening in the market. So I've taken my time to download Zenith Bank financials for 2023. So everything I'm going to share right now will be dependent on the 2023 December financials. So because we're still in second quarter, we're not even seeing second quarter. So 2023 financial will be the best. And remember, we are thinking long term. So let's continue. So here's a breakdown of Zenith Bank metrics. I've done the calculations just to make my job easier, unlike other banks that I have to go through, and that actually made my video a lot more longer. So first thing, Zenith Bank customer deposit has been growing by 65% in the last 4 years. You know the power of customer deposits. It helps to check confidence, customer confidence. When customers like a bank, when they love a bank, when their mind is at rest with a bank, they would most likely want to what? Deposit. So it reflects in customer deposits. When customers don't like a bank, when their confidence level is reducing, bank deposits will go down. So in the last 4 years, Zenith Bank had been growing deposits by an average of 65%. So if I go to Capital Cube, where I get my data, I pay for I pay subscription a lot on different platforms to make my analysis easier. So you come to Capital Cube and you try to register. Some people have been complaining that they are not able to register. It's asking them to pay. I said if you are investing, then you must be ready to pay for the tools that will make your job easier. So this is Zenith Bank financials on Capital Cube. Now look at deposits right here. Look at deposits from 2019. You can see here from 4.3 trillion to 5.3 trillion, 6.5, 9, 15. That's 23. Now, even trailing 12 months is already sitting at 17, meaning that by the end of the year, Zenith Bank will be hitting close to 20 trillion naira deposit. So you can see how the bank had been growing customer deposits consistently, customer confidence. This customer confidence is very important because one of the cheapest way to generate money for a bank is deposits. Deposits. So we'll come to that later. Now, how your deposit is being used. First, 39% of this deposit is invested in treasury bills and others. Others are like investment securities, treasury bill, investment securities, and 43% is disbursed as loan and advances. What does that mean? It means Zenith Bank is a loan-driven bank. You know, I talked about the business of a bank. A bank can be an investment-driven bank. Another bank can also be a loan-driven bank. An investment-driven bank is focused on treasury bill. I know before 2019, before CBN introduced loan to deposit ratio, a lot of banks were putting their money in treasury bill because it was like free money, no stress, rather than giving it to customers and then some of them are going bad. But before CBN steps in and then mandated bank to step up their loan to deposit ratio, that means the loan they are advancing to private sector should probably go as high as 65% or whatever, but I understand that it's been reduced to 50%. So, but Zenith Bank right now is their loan to deposit ratio most likely is sitting around 43%. You can see here, what I did was to look at how much they have advanced out loan and advances to customer against customer deposits. So it's sitting at 43%. So automatically it means they are loan driven bank. So a loan driven bank is one that is focused on generating most interest income from loan and advances. While an interest-driven bank, investment-driven bank is one that focus more on investment. So treasury bill, FGM bond, and all that. Now, what is the cost of funds? When you go to the bank today to borrow, the bank will charge you. That's your interest income. And for depositing money in that bank, the bank is also going to pay you certain interest. So what I did was to look at Zenith Bank cost of funds. So how did I arrive at the cost of fund here? On Zenith Bank financial statements, here you see that under interest income, we have what we call interest and similar expenses here. So interest and similar expenses is what the bank had paid you for keeping your money with them. While interest income is what the bank would earn for lending. That's the loan and advances and other investment securities. So I'd like to look at a breakdown of this figure right here, which is note 7. So if you come here and you look at note 7, so this is note, so you can see under interest and similar expenses, current accounts, savings account, fixed deposit, which is time deposit, they all have bulk of the money right here. Then borrowed fund. Borrowed fund is the interest they pay for on borrowing. So now on the bank's financial statement, we also have what we call customer deposit. There are two ways the bank generates money. The bank generates money via customer deposit and also borrowing. Like here, is any bank deposit sitting at 15 trillion in 2023. And then we also have borrowing. Can you see here? Borrowing of 1.4. Now, for on this customer deposits, this is what the bank has paid out as interest. This. Now, on this borrowed fund, this is what the cost that this particular borrowed fund of 1.4. This is what the bank has paid, which is 96. So what I do is to look at the percentage of customer deposits that they have paid as interest and the percentage of borrowed fund that they have paid out as interest. Then I like that's what we call the cost of funds. So which of them is more expensive and which of them is cheaper? Every bank will want to go for cheaper loan. So if you compare what the bank has borrowed from its customers, or from the deposit that mobilized from customers and what it has borrowed from external parties investor, the bank cost of debt is 7%, sorry, 7%. Now, 7% here means if you divide 99.116 here, 99.116 divided by the borrowed fund of 1.4, that will give you 7%. And cost of deposits is when you divide customers' deposits. You can see here, right here. So if you do customer deposit 15.1, so if you add 1, 2, 3, and then you divide it by 15.1, that gives you 2%. So what exactly does this mean? It means that the cost of raising deposits is 2%. The bank pays 2%. The cost of loan, sorry, the cost of deposit 2%, and cost of debt is 7%. What does it mean? It's cheaper to raise money via deposit than borrowing, than debt. So Zenith Bank, bulk of Zenith Bank inflow, cash, actually comes from customer deposits right here. We've already established that. So you see deposit is 15 trillion against 1.4. So you now understand why Zenith Bank would prefer to mobilize, push customers to open an account with them, because the cost of borrowing this money is a lot more cheaper than going to borrow this one here. So this customer deposit here, the cost of attracting customer deposits or mobilizing deposits is a lot more cheaper. If I attract 15 trillion or deposit, I'm going to pay 2% as interest. But if I come in here, I'm going to pay 7%. That's almost 3.5% times what is. So what do you think a smart bank or a smart manager would do? They would rather mobilize funds via customer deposits. That means they want to do everything possible to make sure that customer experience is okay. Number one, customers are happy. Customers mobile banking experience, when they come to the bank to complain, their issues are resolved, because it's when customers are happy that they want to deposit more. And deposit is cheaper for them compared to cost of debt. You can see what data is revealing about any bank. Now, by looking at the fact that customer deposit has been increasing by 65%, it means that any bank will continue to strive to increase customer deposit just to make sure that they are able to raise more funds at a cheap price. Now, not even at this time when interest rates, cost of loan is a lot more expensive. If you go issue commercial paper right now in the market, it's way high. So banks are shying away from commercial paper for now because rates are high. Rather, they will prefer to do anything to attract customers and make sure that customers continue to deposit with them. So this is what my metric is saying about Zenith Bank. Customer deposit very well. The bank is a loan-driven bank. Cost of funds is very, very, very low, which is what 2% for deposit and 7% for debt. Now, the bank would rather prefer to go mobilize customer deposits. More metrics on Zenith Bank. Now, net interest margin. What is net interest margin of a bank? Now, what are we looking at? We're looking at the interest-bearing asset of a bank. What is the asset that generates interest from Zenith Bank financial statements? The asset that generates interest right here are the treasury bill of 2.7. We have the loan and advances right here of 6.5, and then some part of these investment securities, because when I did a check on these investment securities, I also saw equities. Banks don't generate interest from equities, they generate dividends from equities. So on that equities, I saw debts and equity. So debt generates interest income. So I had to pick the figure from debt. So by adding that figure to loan and advances and treasury bill, we are able to arrive at what we call the interest-bearing assets. Interest-bearing assets are all the bank exposures that generate interest income. Now, what is the net interest income of the bank? The net interest income of the bank is 736 billion naira. And if you look at the bank's P&L as at 2023, you also find that figure here. You can see 736 billion naira. So by the time you divide 736 by 12.2, that means net interest margin is 6%. So let me explain what this means. Now, Zenith Bank net interest margin is 6%. Now, 6% means that by the time we mobilize funds from our customers and our debtors, and we give the loan out, give the money out as loan and advances, some invested in treasury bill, some in also other debt securities so that we can generate income. We earn an average of 6% on that particular assets. Now, that money that we have earned 6%, we are not the owner. We collected some from our creditors, we collected some from our customers. How much are we paying our customers? Now, for the creditors, some of them earn 7%. And remember, the proportion of the debts and customer deposits is very, very low, 1.4 against 15 trillion. But bulk of that money, bulk of this money actually comes from customer deposits. And how much is the bank paying to customers on average? 2%. 2%. Because when you look at the interest on current account, interest on savings account, interest on time deposits right here, and you compare it with the customer deposits in total, that's 2%. 2%. So that means the bank is actually making more money from our deposits. So some of us will say, oh, this bank always collects interest. In short, Zenith Bank is known for always debiting us on a Sunday, just like other banks do for charges, maintenance, and all that, because bank incurs expenses and all that. Now, if I'm looking at it as an investor, I would rather own any bank shares so that at the end of the year, I will collect my dividends. Now, so I tell people, if you're complaining that your banks are charging you, why not buy their shares so you can collect that charges back as dividends? It's simple. So this is any bank here. This is the number telling you that this bank is paying just 2%. And the bulk of these bank funds actually come from customer deposits. Look at customer deposits of over 15 trillion. Total liability so far is 18. Out of 18, 15 is coming from customer. That means any bank is enjoying cheap money. Zenith Bank is enjoying cheap money. And a bank will not just enjoy cheap money like this if customers don't trust it. And one of the things that the bank has enjoyed is brand loyalty. Brand loyalty. That's why you see a lot of people, no matter what happened, in Zenith Bank, because they've been known to be stable, consistent, and brand loyalty plays a major role. So you shouldn't be surprised that the bulk of Zenith Bank liability is coming from customer deposits. And what is the cost of this deposit? 2%. Very low. Very, very low. Very, very low. So let's finish up the metrics. Now, efficiency ratio. This is also very important. How efficient is the bank? Cost to income ratio. Operating expenses of the bank is 449 billion. So in operating expenses, we add depreciation, we add the staff salaries, which is personnel expenses here. depreciation, amortization, personnel expenses, operating expenses. So everything actually gave me 449. And then by the time you add the gross income here covers both the interest income and non-interest income. So when you add the net interest income, you add fees and commissions, trading income, everything, that will give you the gross earnings of that bank. So 44 divided by this, so cost to income ratio is sitting at 27. Very, very okay. Now, like efficiency ratio that is below 50%. Efficiency ratio below 50% shows that the bank is able to manage costs very, very well. So when you say a bank is efficient or a company is efficient, what does that mean? It means that the company is able to manage costs and generate higher revenue. So the bank is spending just 27 kobo for every 1 naira that they generate. So cost to income of 27% looks good, it looks okay. And when efficiency ratio is very high because of low cost to income ratio, what happened? Bank's profit will be higher too. So that also explains why Zenith Bank ranks among the top when it comes to return on equity. So return on equity is sitting at a whopping 29%. Return on equity here is looking at the profit after tax against the ordinary shares. So profit after tax of Zenith Bank was around seven. Let me look at profit after tax of the bank here, 676 billion against the equity that company. So that gives 29% here. If you look at, yes, equity right here. So that gives you 29%. So look at these metrics. Does it make sense to you? Yes, it makes sense to me because this is the kind of bank you are looking for. I would have just jumped in to say Zenith Bank is stable, is nice, but I wanted to use the number to let you see how stable, how the bank is enjoying free cash flow, how brand loyalty is paying off, and how it's driving consistent growth in customer deposits, and how that is giving the bank more money to generate more income via interest income, that's via loan and advances, and also investment in other securities. But note, Zenith Bank is a loan-driven bank. So after looking at this right here, there is something I want to share with you. Zenith Bank is actually a high-yield, growing passive income banking stock. So if you ask me whether Zenith Bank is good or not, my question to you is, are you buying Zenith Bank for growth or income investing? If you're buying Zenith Bank for income investing, please buy Zenith Bank. I am strongly recommending the banking stock for income. Why? Because the bank has proven to be a high yield, growing passive income. High yield in the sense that dividend yield is very high right now, among the top in the market. Growing means that the bank is consistently paying higher dividend per share, at least almost every year. If not almost every year, every 2 years, the bank dividend payout is always higher. And passive income in the sense that you don't have to do anything. Just own the shares, sit back, and collect your dividend every year. So let me show you why I think Zenith Bank is a high yield, growing passive income. This particular statement is designed for income investors, those that want to own Zenith Bank for a long time, those are looking to build wealth, build assets that will continue to pay regular cash flow. So this is it here. Dividend yield of Zenith Bank is sitting around 10.49%. Now, in my video, when I recommend dividend stocks, what is the minimum yield? My members know me very well. Any stock that pays below 10%, I don't recommend it. So for me to recommend a stock for dividend or for investing, the dividend yield must be at least 10.49%. That's key. Now, dividend per share growth is steady. Why did I say that? Everything I share here will not be based on assumption. I don't want to assume. That's why I'm taking my time to show you data. So let me show you another data that proves that Zenith Bank has been paying higher dividend per share. So this is investing.com. And I want to take you to the dividend history of Zenith Bank. So let's look at dividend history of Zenith Bank. Okay, yes, this dividend history of Zenith Bank. Now, Zenith Bank has been paying dividends for a long time. So we call it dividend aristocrats. Any bank or any company that is able to pay dividend for at least 10 years, call it dividend aristocrats. And any bank has been doing that from here. You can see this particular website started tracking dividend from 2005. So, but doesn't mean that's when any bank started paying dividend. So note that I'm just looking at data here. From 2005 to 2024 is like how many years now? 19 years. It's like 19 years. So here, look at the amount the bank has been paying year on year. Now, so far in 2024, 2023, it paid 3.5. Interim was 0.5. That's 4 naira. Now, 2022, it paid 2.9 plus 3, 3.2. You can see from 4 naira, 3.2. Then 2021, 2.8 to 0.3. That's what, 3.1. Then 2020, 2.73. You can see 3, 3.1, 3.2, 4. So that means we should be expecting not less than 4 naira dividend from Zenith Bank in 2024, 2025. Then if you look at other years now, 0.3, 2.5 here. Yeah, sorry, 2.5 to 0.3, 2.8. You can see here, this is 2.6. Here you can see almost 2. So you can see there's consistent growth to year on year. So I call it a growing passive income. So it's not just high, it's also growing. So dividend per share growth is steady almost every year. Now, dividend payout is also moderate. What exactly do I mean by dividend payout? It's not enough for a bank to pay dividend. I don't like it when a bank pays dividend and it doesn't have enough to retain for growth. So when a bank pays dividend, try to pay attention to its reinvestment, because when it makes a profit, it's supposed to pay you, right, as shareholder. Now, have you asked yourself that question? Because you don't have to think as a selfish investor. Is the bank investing in itself? How do you know that a bank is investing in itself? By looking at dividend payout ratio. If a bank is paying out 100% of its profits, it's not a good sign. So what exactly does the bank have that will help you to reinvest in growth? So I like a bank that pays out a certain portion of its profit and then reinvest the rest. That's what we call dividend payout, retained earnings. So you can see here the retained earning of Zenith Bank. You can see Zenith Bank has a lot from here 123 to 136, 168 to 194. You can see how the bank had been growing its retained earning. Retained earning is the portion of a bank profit or a company profit that is not paid out. And most times, this retained earnings is used to fund growth and expansion. So if retained earning is very, very okay, then it means you will be assured of dividend payout in the future. So let me look at the income statement of Zenith Bank. I want to show you something. Okay, right here. Now, see here, let's look at this is dividend per share, DPS. You can see dividend per share 3. Now, look at the earnings per share, 7.73, right here, 7.73. Now, a bank earns 7.73 naira. Let's say 7.3. Now, out of 7.73, it's paying out 3.5. So the dividend payout will be 3.5 divided by 7.73. 45%, which is very okay. I don't like dividend payout to be above 50%. Dividend payout below 50% is okay for me. That means even though the bank is paying out a lot of dividends, increasing dividend, it's still retaining more to invest in growth and expansion, and also to keep as retained earning. Retained earning is good and it serves as a buffer. When you make a profit and you distribute some to your shareholder, you keep some. That one you have kept to reinvest in growth. It is that growth that will drive higher payouts tomorrow. So why is any bank increasing dividend payout? Because any bank has been investing in growth. If any bank had not been growing, that means they won't be able to pay out more dividends in the future. So the dividend payout is tied to your dividend per share growth. And revenue growth is also very key. Revenue growth. Zenith Bank has been growing revenue year on year. Zenith Bank has been growing revenue year on year. If I come here and I look at the income statement of Zenith Bank, you see growth 415, 420, 427, 540, 1.1, almost trillion, 1.6 trillion. Can you see already trailing 12 months is already higher than the previous full year? So, although we're expecting Q2 results very soon, return on equity is above industry average. Retained earning is enough to guarantee future payouts or bonus, if any. I've already shared the importance of retained earning. Any company that doesn't have good retained earning, then you can't be rest assured. You can't be assured that your future payouts or future dividends be there. So some companies are already carrying negative retained earning. That's why they cannot pay dividend. Even though they are making profit, they are only using that profit to be able to move that retained earning back into positive range. Because any company that is carrying negative retained earning and is paying dividends is a red sign. Because why would you be paying dividends when you're retained earning because how are you investing in growth? But for a bank that has robust earnings and also robust retained earning, then it means that this bank would continue to guarantee your future payout tomorrow. So this is the reason I said Zenith Bank is a high yield growing passive income. High yield dividend is above 10%. Growing dividend per share growth has been steady. Dividend payout has been moderate. Revenue growth has been steady. And then passive income, meaning that the company will continue to pay you dividend without doing anything. Just buy the shares and keep. So Zenith Bank is actually good for income investing. Now, for anybody that is looking to buy for growth, it still doesn't mean Zenith Bank share will not appreciate, because what makes a share to appreciate is when the demand for it is higher. So for income investor, once they start mopping up Zenith Bank shares because they think, oh, this is the kind of bank we want to own, higher demand automatically leads to higher share price. So there are times where I will buy a share, a company that pays dividend because of share price appreciation. Because I think that once the market notices the company, they start buying the share for income, which is the essence. They will start bidding higher because of rising demand. And you know what it means? Rising demand automatically translates to increase in share price. So Zenith Bank for me is a very good bank and is a strong bank and is perfect for income investing. So I need to break down this objective so that I don't just tell you Zenith Bank is a buy and then you don't know whether you are investing for income or not. That's why I had to first educate you on your investment objective. Then you now come down to whether Zenith Bank is a buy or not. So look at the data that I've shared with you so far. Is Zenith Bank a buy? Yes, it's good for income investing because the data is telling me that this bank is strong. This bank is generating cheap money from our deposit. So why would I sit back, a customer of any bank, haven't seen this data and not own their shares? It's not possible. So let me also share something. Some of them might say 10%. Is it not small? In a country where Nigeria's inflation is as high as 30%. But then let me show you a principle. Let me show you one concept in wealth growth that has helped me to accumulate smaller return rather than looking for overnight return of 100%. Now, can I beat inflation of 33%, 33 to 40% with just 10.49% dividend? Yes, you can. Yes, you can. By compounding 10.49% annually, that means if you collect your dividend this year, definitely it's going to be higher. It is going to be higher than 10%. So for anybody that buys today, by the time any bank pays you 4.5 or 4.5, yes, or maybe they increase to 5 naira or thereabout, you're going to earn more than 10%. So, but then let's look at this. By compounding 10.4% annually, you can power your Zenith Bank's dividend to 64% every year after reinvesting for 5 years. What does that mean? If in the first year you collect your dividend of 10.49%, don't spend it. Use it to buy the other Zenith Bank shares. The following year, your total return will no longer be 10% because you have compounded. The second year, you collect higher dividends, compound it again, buy more of the share. That means you make up your mind to always increase your shareholding with the dividend that is being paid out. It's as good as saying you're buying Zenith Bank shares for free because it's at zero cost to you right now. What are you using to buy? Your dividend. And if you decide to add more cash, fine. But here's the point. When you reinvest that dividend every year for 5 years, your share price, your return would have increased to 64%. So here, one, two, three, four, five. Yes. Can you see here? This is just one. Remember, it's 10.49. So I'm just doing 1%, almost 61. So if I add 0.49, 0.49 here, 0.49 here, 0.49 here, and 0.49 here, and 0.49 here. Can you see 64%? So that means in fifth year, your portfolio would have grown by this percentage. Can you see here? By the time you start collecting your dividend after 5 years, I know I don't want to talk about it. So the bank has historically paid higher dividend almost every year, which could take your estimated return to 70 to 80% in the next 5 years. So this is irrespective of share price appreciation. If you had, if you have watched my video on dividend to income, so if you go to Coach Oge, I shed more light on this, how to pick great dividend stocks in the markets, how to pick great dividend stocks in the markets. So let me show you that particular video. I have a video course on dividend to income. Dividend to, yeah, this is it here. Beginner to dividend income, right here. If you watch this video, you will see how you can power your dividends annually. Do you understand? How you can power your dividend to a guarantee 16, 20%, even 25% every year. Every year, the secret and how to choose a good dividend stock. And Zenith Bank is one of them. I used three banks to estimate this if you had invested in the last 5 years. And here I went deeper to talk about their data, their financials. So it will open your eyes to knowing how to pick good dividend stocks. So don't limit your mindset to just this one time 10% that is going to come in every year. Compound that return. That is where the money is. But make sure you are doing it on a stock that you consider stable, on a stock that has good fundamentals, on a stock that has history of consistent dividend growth and also dividend payouts to their shareholders. So I hope this video had opened your eyes on Zenith Bank stock. And right now, you now understand better on why you should mop up Zenith Bank stock as an income investor and why Zenith Bank is a passive income stock, high yield, growing passive income stock. So question now is, how do I buy Zenith Bank? So I decided to chip this in to make it easier for you because in the last section, a lot of people have been asking me, oh, how can I buy? How can I buy? How can I buy? So I like to have a contact point in the bank that to make it easier for you. So here, how to invest in any bank stock. So just for people that might need assistance, might need a guide on how to invest in any bank stock, or probably they need someone to guide them to help them out, or in case they have questions or they want to track their investments in case there's an issue. Because a lot of people have complained that, oh, we bought shares some years ago, we couldn't track it. It's because you never had a contact point. That's why. So here, investing is not all about putting your money in your account and letting it run. You need a support partner or a channel you can always refer to when you have questions. You don't have a brokerage account and you're wondering, oh, okay, how can I buy this any bank stock? Now, even if you don't buy for yourself, how can I buy it for my kids? How can I buy it for my children? How can I use to create? Remember, income investing. How can I build a long-term wealth for my children in the sense that in the next 18 years, by the time we start investing the dividend, it would have been something significant. So here, I actually bought mine through any bank account officer and Airport Road, and they promised to help anyone that I want to hear a story. So if you want to contact my account officer, this is the number. You can contact the person here. It's the Gmail. So you can just send a mail that, oh, I just finished watching a video on Coach Oge's platform on Zenith Bank that I'm interested in buying Zenith Bank stock. So you can just take it up from there. But for anyone that thinks you know how to do it yourself without any issue, it's fine, no problem. But then this is how people, especially for elderly ones or for people who are not used to the market or who are looking to come into the market for the first time and are looking for guide on how to buy any bank stock. This is actually a number to contact to help you. Now, I can vet for this person. Like all my issues so contact this person for guide on how to buy Zenith Bank stock.